All right, welcome back to the Tech Corner. I'm George Tillis, Senior Markets Contributor here with the Schwab Network. And on this edition of the Tech Corner, we're going to be highlighting Amazon. Now, everyone knows Amazon is a global leader in retail sales of consumer products, advertising, and subscription services through its online and physical stores. The company operates really through three main segments. Its North American, international, and its technology-based Amazon Web Services division. Over the years, Amazon has become a dominant player in various sectors by offering an extensive range of products and services. While designated as a consumer discretionary stock with its large e-commerce platform, the company also holds a large role in cloud computing, digital streaming, and advancements in artificial intelligence. Amazon also provides services enabling sellers to market their products in stores and supports content creators like authors and filmmakers to distribute their work. A significant part of Amazon's revenue is driven by its Amazon Web Services division, which offers a comprehensive suite of cloud services, including compute, storage, database, analytics, and machine learning. Advertising services are another major revenue stream, with Amazon providing sponsored ads, display, and video advertising. The company is also well known for its Amazon Prime membership program, delivering benefits such as fast and free shipping and access to streaming services. Now, when we break down the composition of Amazon's revenues, a few to consider include its online stores, physical stores, which constitute about 40% of sales, Amazon Web Services, which represents about 18%, as well as its third-party seller services, which constitutes about 24% of sales. Another up-and-coming segment to consider here that's growing is advertising services, which now constitute about 9% of total sales. Now, when it comes to competitors, Amazon faces fierce competition from several key players across its diverse business segments. This includes Walmart Incorporated, which is a major competitor in the retail sector, both online as well as an in-store presence. Microsoft competes with Amazon in the cloud services space through its Azure platform, which is rapidly growing and gaining market share. Alibaba Group also is a significant competitor in the e-commerce space, especially in Asia, where it has a strong market presence. Now, Amazon's unique value proposition lies in its extensive integrated ecosystem that combines e-commerce, cloud computing, and digital advertising. Its ability to leverage vast amounts of consumer data across its platform enhances its targeted advertising capabilities. AWS's comprehensive cloud services infrastructure supports a wide range of industries, providing significant scalability and innovation in AI and machine learning. Furthermore, Amazon investment in logistics and fulfillment technologies ensures fast delivery, enhancing customer satisfaction and loyalty. Now, in recent news, just going back to the 1st of May of this year, Amazon reported their first quarter results that beat the high end of the guidance, both on the top and bottom line. Total revenue for the company grew 10% year over year to $155.7 billion. Amazon Web Services revenue grew 17% year over year, while its North American sales grew by 8%. More importantly, the operating margin was higher to 11.8% versus 10.7% a year ago. Currency headwinds, however, impacted sales growth by about $1.4 billion. However, this was offset by posting another strong quarter for retail margins. Management also indicated in their conference call they believe that Prime will enable Amazon Retail to outperform in the evolving tariff economy. In the most recent week, going back to May 22nd, the Amazon-based OpenAI rival Anthropic launched its most powerful group of artificial intelligence model yet, called Claude 4. Also that same day, interesting enough, activist investment fund Pershing Square Holdings, led by Bill Ackman, disclosed during an investor event that it holds a new position in Amazon. However, it's an undisclosed amount. Now, there are many positives to consider with Amazon. First, it demonstrates outstanding growth compared to retail peers. For instance, year-over-year revenue growth last quarter grew 10%, massively outpacing the sector's 2% growth. Additionally, earnings per share growth on a forward basis is expected to be an impressive 36%. This is meaningfully higher than its 5-year average of around 23%. Amazon's AWS division is also still experiencing robust growth, with a revenue run rate exceeding $100 billion, driven by its cloud and artificial intelligence expansion, positioning it strongly against competitors like Microsoft's Azure. The company also boasts superior profitability metrics compared to other mainstay retailers like Walmart, with a net income margin of 10%, which is much higher than the sector average of around 4%. The company's strategic investments in artificial intelligence and robotics are enhancing operational efficiencies in its fulfillment centers, contributing to the margin expansion and long-term value creation of the business. Amazon's advertising business also continues to grow significantly, as I mentioned before, with a year-over-year growth rate last quarter of 19% by leveraging its extensive user base across platforms like Prime Video, Twitch, and Amazon Music. Now, despite many positive things about Amazon, we also have to address some of the concerns. First of all, Amazon's AWS total competitive market share has fallen below 30% for the first time, with Microsoft Azure growing at a much faster rate, highlighting competitive pressures presented in the cloud market. For instance, Microsoft Azure is growing at around 21% year over year based on their last reported earnings, versus Amazon Web Services growing at around 17%. The ongoing tariff wars pose a significant risk to Amazon's e-commerce business as well, especially with its reliance on China-based sellers and goods, potentially impacting future profitability and revenue growth. Now, other risks include how any potential macroeconomic slowdown may impact cyclical revenues, such as advertising and AWS, any legal or regulatory challenges, rising domestic and international competition, and earnings volatility from Forex fluctuations. Lastly, the heavy AI-driven CapEx cycle and demand for quicker return on investment also present near-term risks. Now, when looking at the charts from a technical analysis standpoint, the stock shows slight positive annual relative momentum with a 52-week price increase of 13% compared to the S&P rise of around 11%. However, year-to-date, the stock is down over 5%, while the S&P 500 is slightly higher by 1%. This is suggestive of potentially the tariffs impacting Amazon more than the broader market. The stock is also still down approximately 15% from a year-to-date high established in early February. Now, when evaluating average indicators, the stock is in the congestion zone of moving averages. It's above the 20, 50, and 200-day moving averages, attempting to reclaim technical resistance levels established in late March above the $207 level. The 50-day moving average remains below the 200-day moving average, which suggests the intermediate-term trend may be sideways, pending another near-term catalyst, which could either advance the stock higher or lower. Now, in summary, Amazon remains a dominant force in the e-commerce and cloud computing space, with strong revenue growth and improving profitability. While macroeconomic and regulatory risks persist, Amazon Web Services, advertising, and its cost efficiencies provide a solid foundation for future growth. The company continues to post strong and improving retail margins, and management believes the convenience of Prime will enable Amazon to outperform in the evolving tariff economy. In a consumer retail environment made uncertain by shifting trade policy, Amazon appears to have retained market share gains that it built during the pandemic. Now, going forward, investors should always consider monitoring a few factors. That includes Amazon Web Services' growth trajectory, retail margins, and improvement in any regulatory developments. Now, in next week's edition of the Tech Corner, we'll be highlighting well-known communications application software company, Zoom Communications. Now, thanks again for joining us on this week's edition of the Tech Corner. Please like and subscribe to the Schwab Network. I'm George Tillis. We'll see you next time.